Hello fellow traders. In this video I'm going to try and put together most of the set and forget supply and demand rules that you can find in the community. By doing a simple exercise on one single time frame, you're going to see how most of the rules can be found there. So exercising and practicing how to draw trade lines and imbalances, the chain and all that will give you a lot of experience on how to do this. Most of the rules will be covered, not all of them, obviously, but most important rules will be covered, as you will see. Maybe it's going to take me half an hour to record a video, but well, it doesn't matter. We're going to see the fractality of price, new imbalances created at all-time highs or time lows, CPs versus valleys and peaks, tested, fresh, and used up imbalances, impulses that do not become an imbalance. So if they are not imbalances, they are not tradable. We need to wait for confirmation. No consolidation away negates lower time frame imbalances. Same thing, same concept. Overextension after several consecutive continuation patterns. Not all impulses become imbalances, but all imbalances are made of impulses. This is very important. The strength of the impulse, very important. The Y imbalance, the wild trade, after trend line is broken. Tested levels, bigger penetration expected, but it doesn't always happens. Tested on departure, this is not a tested level, but we usually see bigger penetration. Demand eliminated, supply created, and vice versa, so that comes to the chain. And connecting the latest valleys and peaks to draw a trend line and locate new imbalances and turning points. Overshot levels, looking for confirmation, and the famous engulfing lights based on engulfing patterns after a very strong move in price or a very strong imbalance is against the move. And having said that, we're going to load a chart. You are not going to see, I'm cropping the video, so you're not going to see which asset it is or which time frame it is, because it doesn't really matter. It is the first point of this video, fractality of price. Whatever happens on one time frame can happen on lower time frames. So this time frame could be the daily on a stock that doesn't have too much history, could be the weekly, the 3 months, the monthly. It doesn't really matter because these structures happen all over the place. The engulfing patterns, the high wave candles, the pulses, overshot levels, and all that. It happens the same on all time frames. So that's why we have the sequence. We have 3 time frames, the top one, the middle one, and the low one, which is the end time frame, and then we decide based on what we do know each of them. We put them together and we get an answer that we usually don't like, because it's usually, hey, you do not trade this one, but that's trading, at least supply and demand. Okay, good. So we're going to start from the very left and we're going to end up here, and we're going to see how rules are playing out all the way up. Okay, so to start with, we have price here on April 2001 that was dropping very strongly. Okay, and since this is all we have, all history we have, this has to be supply. This is all-time lows, drop, base, sorry, bases and drops, consolidates away. All these candles are over here are the consolidation away for this potential imbalance. Once that happens, this is a confirmed imbalance. Then we have here a pause. It looks like a peak, pause. It is not clear, so we ignore it. It's a CP. If you don't know what it is, it's a CP. Okay, but we do know here that it has been broken. Where? Here. So there must be something over here. Okay, so let's start with this. We have the supply zone at all-time lows. Then we also have another supply zone right here. Why? Because we have the same scenario over here. We have a drop, base, drop, and all these candles until price touches the proximal line are the consolidation away for this level. There's nothing to the left, so whatever it is supply, because and at all-time lows we don't need to remove anything because there's nothing to be removed. We just need to do one imbalance. We need consolidation away and all that as per the rules. So it happens that we have two areas of supply and both of them have been eliminated. So if this one has been eliminated, then there must be some area responsible for eliminating that. So we have to look for pauses or valleys here. There's no pause here. It was eliminated right there. But we go down, 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 and we stop when we see a pause or a valley. And we see a pause right there. And it has like lots of trading over here. Okay, like 3, 6, 8, 7, 8 candles, too much trading. So that should be a higher time frame imbalance, higher than this one, which we don't know what it is. Okay, we don't care. So that should be an area of demand that has eliminated that area. So I move this rectangle over there. I'm going to cover all of it. That's the pause. We could make it a little bit smaller if you want it like that, but it's like that. Okay, so we have demand that based on that. Okay, so we go proceed on the way up, and then price rallies to ERC candles, it bases, and then this area of supply is eliminated. But here you might think that this is the one responsible for eliminating the area because it breaks there. But it is once price breaks that area, the pause, this candle hasn't been created yet. It will be created when the price is here and it closes. So the origin of that impulse is here, not there. If we had had that pause at the imbalance on the left, something like that, then this one would have been the one responsible for eliminating that one, but it is not because we have supply right there on the left. So we have to go back in time and locate the area of imbalance down there, which is the responsible. So we go down and left and we stop until we see a pause or a valley, which are the two potential areas for demand imbalance. Sorry. So here we have the area of demand. Okay, over there. That's the area of demand. Okay, we're gonna go step by step. Okay, it's being over short. So for now on, let me do this. A vertical line here. From now on, we don't have price action from this vertical line to the right. It's not available. Okay, so maybe we could, I think I could use this one. I think there is a, I haven't used it for some time, so okay, yes. Okay, so I can, no, I need to practice this before I can do it, okay? So I can show the candles and all that, okay, no problem. But you're understanding what I'm trying to say, because I'm doing it slowly and all that. So, price continues to rally. And here, all this is a void. There's nothing to the left, nothing to be removed. So this one over here, this guy over here, should be demand. Because there's nothing to be removed and it created a 2-to-1 impulse with consolidation away. This candle over here and these 4 candles are the consolidation away for this impulse. So that confirms that area of demand. So we go and clone this one, select it with control key pressed down, and I drag it. Since it is a single candle at the base, we can encompass the top, the high of the range, okay, top of the range, and the bottom of the upper and lower wicks. So price continues to rally, and after a very strong rally in price, 2-3 ERC candles, we see now this candle over there is a fell ERC. This one also is a fell ERC, and this one is a shooting star. This looks like an inverted hammer or a hammer at the top. So this is telling us that all this is a rejection from whoever is selling their, this may be a forex crosspair stock, whatever. You have had your profit and you are taking profits. So after a very strong rally in price, we expect a bigger penetration. a bigger penetration, sorry, a bigger retracement. And that is what usually happens. So it just can close over here, and then these rejection candles, and it drops all the way down to sorry, this area of demand over here, and it happens that it is eliminated. So, and it is a very strong impulse. If you take a look at this one, this rally ERC candle, ERC candles, and failed ERC, this is a very strong move, and it has been eliminated. That would be one rule that would prevent us from taking that long, and it is this one. Maybe you will come up with it as I'm drawing it. There's a rule that tells us that if we have 3 or more continuation patterns, then price is overextended and confirmation is needed. So we may love this level, but rules prevent us from taking a set and forget long there because this chart is overextended. We have rally base, rally base, rally base, rally. Then these candles tell us that price is bound to have a bigger retracement into this area where we would have expected price to rally, but it just didn't. Okay. So area eliminated. If this area is eliminated, then we have to go to the top, continue, go up here, and pause until we see a peak or a pause. And then we've got our peak over there. So I'm gonna drag this imbalance, this rectangle, and move it to the top so I can draw the supply level. So that is the supply level that was created. Price continue to drop, remove this area of demand over here. Okay, this has been removed. I'm going to draw it like this. And then I'm going to draw this one as well, eliminate it. I'm going to use hollow rectangles to show those have been eliminated. Okay, so this is what we have. An area of demand here. So can we set and forget on this area of demand? No, we can't, because now price is overextended, obviously, and one area of demand has been eliminated. So this area of demand is only tradable if it is nested at a higher time frame area of demand, and it is not. We should have more candles at the base. Okay, so it could be, if this one is a weekly chart, then we would need a monthly chart. So we would need, if this is a weekly candle, then we would need like 4 to 5 candles on the weekly to have a monthly candle, and we only have 2 bases here. So it is not possible that this is a higher time frame, higher than this one. Make sense? So it happens that this level is overshot as well. So on the way up, overextension, we have 1 level and 2 levels of demand eliminated, and now we have a downtrend. As per the rules, the trend defines a downtrend by having 2 peaks, eliminating 1 area of demand, or 2 demand zones being eliminated without the possibility of drawing 2 peaks. This is the second option. Okay, second option where 1 area of demand is eliminated and 2 areas of demand are eliminated. And this is not added in the PowerPoint slide, so I'm going to pause and add it. Okay, added. So this level is overshot. We have a downtrend because we don't have the possibility of drawing a 2 peaks. Okay, so we have here 1 peak, but nothing else. We would have needed another peak making a lower low, but it didn't happen. But we have had 1 and 2 areas of demand eliminated. So as per the rules, we have a downtrend on that time frame. But this is also very common. It is very common to see levels overshot, and when we have a level overshot, and this is a very common pattern, where after a very strong decline in price, we get a hammer plus engulfing pattern. So here comes the engulfing lights. After a very strong move in price, we are expecting a bigger penetration, and this, a bigger retracement. And this is telling us, hey, this is the end of the move. Hammer plus bullish engulfing pattern. Okay, the bullish engulfing pattern is crucial here. Hammer is not. Okay, the more candles confirming bullish bias, the better. So this level is eliminated, overshot, and now in a lower time frame we will be looking to go long counter trend if you are counter trend. We are counter trend traders. Okay, so now price continues to rally. Here's a candle, rally, base, rally. Imagine that you are counter trending. Okay, this impulse here that hasn't consolidated away. So whatever we have down there in lower time frames, it is negated as per the rules. So if this is a monthly chart, then weekly areas of demand and daily areas of demand and 4-hour, 1-hour areas of demand over there are negated because this impulse hasn't consolidated away. This one, as you can see, has. This one has. This one hasn't. And remember, not only that, this is a bullish impulse that didn't consolidate away, but it is in a downtrend because we have eliminated one area and two areas of demand. Okay, so let me remove this one over here and replace it with this one over here, which is demand eliminated. So right now we have, it's raining cats and dogs now. Wow, a thunderstorm. Okay, good. So we have here the top area of supply, and at the bottom we have demand. Price tried to pull liquidity from down there and just couldn't. So that's what we have right now. In a live chart, if this was live right now, we would have price like here. We wouldn't see anything else. Okay? So, one sec, forward. One more candle, and then jump to, well, I don't remember how it works. But well, this is what we have right now, okay? Price rallies and it doesn't consolidate away. So what we can see now, yes, I'm going to exit. It's right there. Is that price doesn't consolidate away, negating everything. And here we have a bearish engulfing pattern, which is telling us the price is very likely going to retrace down there. It just fell short of doing that. But then we have the same thing again. If you look at these four candles over here, the bullish impulse didn't consolidate away, the bearish impulse didn't consolidate away. So demand here is negated, counter trend, okay, and supply here is negated, counter trend as well, with the trend, with the downtrend, okay, because the impulse doesn't consolidate away. It is very common to see that. We want to see impulses like this that become demand with consolidation away, of this one that become demand, okay, or this one, okay, but not this. We don't want to see one candle doing this and then the next candle doing the opposite, different colors, okay. Imagine this is just black and this one is white, okay. So we don't want that. We want to have a really strong drop here, strong drop in price with all this consolidating away, confirming an area of supply in this case. So price continues to rally, and where does it go? It goes to the fresh area of supply. This is a fresh area of supply. So fresh area of supply, if you go up, you go long, you are going long against the trend now. It is time to stop going long in the lower time frames. Remember, this could be any time frame, could be the monthly time frame. So we reaches the monthly area of supply, we are not allowed to go long anymore. Imagine this is a weekly area of supply, no longer the daily and 4-hour. It doesn't really matter. It is supply, it is fresh, it is original, and it accomplished the removal of 1 and 2 areas of demand, and we are in a downtrend. So longs, no way. Okay. After one candle, we have this impulse, very strong impulse that even prints a lower low, it consolidates away and creates a bearish engulfing pattern. If we try now to draw the trend lines, we have a valley, another valley. So we should be able to draw a bullish trend line. And that bullish trend line has been broken, and all these candles here are the consolidation away. So we have created we have had a new area of supply created right there at this bearish engulfing pattern, which is a brand new level confirming the power and the strength of this area of supply at all-time highs, whichever time frame it is. We don't care. Okay, very strong impulse. So this is a wow trade. This is what we call the wow, which is a a new level of supply created at a high time frame confluence supply and 20 MA trend lines and all that. So this one has a high time frame confluence, which is this area of imbalance. And then price pauses over there and then drops again. Okay? Price continues to drop. Okay? But here, before it retraces into this area, we have a rally, a base, and a rally. Okay? And this guy over here, accomplished nothing, which is also mentioned in the PowerPoint slide. We need to accomplish something. So it rallies, bases and rallies, and this area of supply is not eliminated, so this is just an impulse. Not all impulses become an imbalance, but all imbalances are made of impulses. This is crucial. This is key to understanding supply and demand. Okay. Moreover, we have a brand new area of supply created as a retest and confirmation of a bigger area of supply at all-time highs. So going long here, not allowed. We are looking for short when price is very close to this area of supply high in the range. Okay, that's what happens on the way up. On the way down, we have price drops, rallies, and then drops again, make a lower low. So by having that, let me draw this trend line here and keep it there, broken. That over there, and now we have brand new bearish trend line. Once there is a candle, full candle like this one, all this is the consolidation way. We need consolidation way to confirm the break of the trend line. We have bearish impulses, and suddenly we have a bullish impulse stronger than the previous one. So this is a piercing pattern. We draw piercing patterns like that as demand. So we have brand new area of demand higher than the previous 16 area of demand down there. So we have price ranging now between this area of supply, which is tested now, and this area of demand. Price continues to drop and all the way down here. And after engulfing pattern, engulfing lights again, is telling us, hey, I am not going higher anymore. I am bound to retrace all the way down. And that's what happened. Okay? So this is what we have right now. So this area of demand, created, price retraces all the way down. And here we have again another example of the engulfing lights. After a very strong decline in price, we get a doji plus an engulfing pattern. This is telling us, hey, I am not going lower anymore. Moreover, we have a fresh area of demand right there on that time frame. So going short here, there, it's not possible. We need to go short. We can only go short once we reach these areas of supply. Not in the middle, not at the bottom of range. So 3 months engulfing pattern, bullish engulfing light, and price starts rallying and goes all the way up with this new impulse and this new engulfing pattern, and then a rally, base, and a rally. And the break of a previous tested area of supply, expecting bigger penetration because it was fully penetrated, and its first retracement accomplished nothing. So expecting a bigger penetration, and that is exactly what happened. So the break of this area of supply okay, is happening right there. So in order to locate an imbalance, the imbalance responsible for the break of that area of supply, we need to go down, okay, and left until we see a pause or a valley. So we see this pause and we say, yeah, here we have our area of demand. Okay, wrong. Why? Because this rally, okay, here hasn't consolidated away. We need candles away from the proximal potential proximal line of that month imbalance. Okay, so if price would have continued like this would have been the candle that we say consolidated away, confirming the strength of the impulse. But it didn't. It rallied and the next candle was a bearish engulfing pattern. Bearish engulfing light, we're expecting price to retrace to the opposing engulfing pattern or the origin of the move at an imbalance. Okay, so this is what we have right now. So if this impulse was not the one that removed that one, we have to continue to go lower and locate the next pattern, which is right there. So this guy over here did consolidate away. Why? This candle, both this candle and this candle are the consolidation away for this impulse. Here, no consolidation away. Here, yes. So we have this area of supply eliminated, this area of demand created. So I'm gonna draw this area here, which has been broken by this guy over here. Okay, this is red. Price hits that, removes that area of supply, no consideration away, engulfing light, vanishing off the button, and retraces all the way down. And now it is creating new engulfing pattern of this new area of demand. We made a high on this high, so this is a valley here, and then we have another valley there, so we can connect these two. So what do we have now then? So we have two valleys and one area of supply eliminated here equals to uptrend. 3 months uptrend with a brand new area of demand here. I just said the time frame. I didn't want to, but I just escaped. Well, it was the last price action, so it doesn't really matter. Okay, this is a 3 months chart on this stock. Okay, but it was the last candle, so it doesn't really matter. So now that we have this area of demand over there, with an uptrend, we can go long here, expecting price to make even a bigger penetration, okay? Because this area of supply at the top is used up, okay? We have an obstacle there in lower time frames. That will be lower time frame areas of supply, but still room, probably new areas of demand on lower time frames here created, and all that. And this is it, more or less. In this small chart with hardly maybe 50 candles, we have covered many of the rules. Most important rules are using set and forget supply and demand methodology. Okay, so make sure that you go over this, that you practice this at home on as many charts as possible. And remember, this is just one chart of your sequence. If this is a 3 months chart and you are trading stocks like I do on the 3 month sequence, you will need to do this one on this analysis on the 3 months chart, on the monthly, and on the weekly. The weekly will be the entry time frame. I will be looking for longs, a weekly average of demand over there. If this was the monthly chart, then you will be looking to go long at the daily time frame. Okay, if this was the daily time frame, hourly imbalances on there. It doesn't really matter. I mean, you just have to do this on 3 time frames on your chosen sequence and make a trading decision based on what the 3 time frames tell you to do. Most of the time the answer will be cross on, sit in your hands, do nothing. That's it. That's trading. 99% of the time is doing nothing, waiting and waiting and waiting. And there are different levels of waiting, but waiting is what you mostly do when trading. The less you want to trade, to wait, the more trades you're going to have and the more losses you're going to have, and more impatient you're going to be. If you have had no trade for a week, then I'm sure you're going to be drilling it down to lower time frames, looking for to satisfy your ego. So there are two options for that. One is, instead of trading like 20 assets in your basket, your portfolio, maybe cross pairs on forex cross pairs, add more, 40, 60, 80. If you are only trading forex cross pairs, add indexes, add commodities, then you can add stocks. It's crazy. There are so many out there. Okay, so that's what I'm doing now. I'm just tracking hundreds of stocks, and currently I have like 180 stocks, more than that in my watch list, obviously. But uh, in a 3 months uptrend with 3 months areas of demand, 6 months areas of demand in control, I have 180 stocks doing that. I'm playing out. Those imbalances are playing out nicely. So why do I need to look at over time frames? I don't need that. Okay, but that's the way I do it. I'm telling you why. So I just have to look at the chart once a week, once every 2 weeks, or when I get an alert. That's it. That's what I want my training to be. If you want your training to be, sitting all day long or a few hours a day in front of the charts, okay, no problem. That's fine. It works as well, but not for me. It used to work like that, but not anymore. And that's everything. Hope that you have enjoyed this video and you put all this into practice thousands of times, not hundreds, thousands of times. Okay, enjoy the rest of the day, and if you need anything, just contact me. Bye bye.